All right. All right. So, welcome, welcome. Now, I got to tell you guys, the feds dropped the bomb on us, and um, we're going to take a look at that today. Is it really as bad as we thought it was? The rate hike, 75 basis points. Is it really that bad? As always, we have our expert contributor Gilbert Bennett with My Easy Mortgage. We're gonna get in there. We're gonna take a look at what the Fed actually said, and we're gonna unpack exactly what he said to see if it's bad for us, for the normal investor. Possibly you're buying a house. Maybe it may affect the seller. Let's bring Gilbert on up and have him explain everything to us. Gilbert, how
Hey,
you doing?
David, this is Gilbert, or I'm here, I guess you'd say. You guys see me. Listen, we're talking about the Fed. So you want to hear some interesting news? Fed announces rate hike. We've seen small, very small improvements to mortgage pricing. Boom, 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 boom. Every few hours on the mortgage bond in the bond market since then. Now, I'm not saying we dropping rates significantly, but it's costing a little bit less for each rate track. Why? Because that's honestly already built into the mortgage market.
Mhm.
That's what's expected. Um, when the Fed raises that base rate, what you see is you see an increase in those things like we talked about on prior shows, the cost of, in particular, revolving debt. So that could be credit cards, that can be home equity lines of credit, that can be things based on some of those debt indexes and or based on the prime rate. And the Fed's not actually raising the prime rate, but that's kind of a trickle down effect of the Fed raising their rates is that
Mhm.
prime rate going up.
Mhm.
But another interesting thing you see, you're starting to see more advertisements for high yield savings accounts. Remember the last time we had the Fed raising rates to fight inflation, you were seeing 2.5%, 2.9. I saw a high yield savings account today at 2.69%, meaning you get a 2.69% on the money you have in your savings account. So your 6 month nest egg that you should have, right, to weather any storm,
Right.
you can make 6% on that. I mean, that's great compared to the 0.001,
Right. Right.
you normally get with some of these online banks, and et cetera.
All right.
So,
So before we dig too deep in there, let's get in there and see exactly what he said, and then we're gonna come back and get some more real market reactions to that. Okay.
yeah.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time.
All right. So let's do this. Let's unpack that. So Gilbert, in layman terms, what did he say? He said
Well,
75 basis point. He said that they are committed to reducing inflation down to 2%. And then he said about how he thinks is going to be over a long haul. What does that mean to a professional like yourself?
so two things, and really to address this, you kind of got to look at what happened to combat recession, right? What did the Fed do to combat recession during COVID? We had people losing jobs. We had no supplies, or a lot of commodities and supplies weren't moving around. because of basically because of supply chain issues related to not having workers working, not having producers producing, et cetera. The Fed went out and they spent money. They bought mortgage-backed securities. They bought U.S. Treasuries. They did things that artificially lowered mortgage rates, that artificially lowered the yield on U.S. Treasuries and U.S. bonds by being a primary buyer of those things, and basically kind of almost saying controlling the cost on it. And what that was doing was putting money into the economy, putting money in the financial institutions and into the economy so that money got lent out, right? So that the money got utilized, the Treasury, so that the Treasury Department could fund some of the COVID stimulus programs, et cetera. Right now, Powell is talking about, in that clip right there, he's saying, you know what, we are going to continue to raise interest rates until we see the economy slow down enough, until we see or restrict money supply enough to reduce fast spending, to reduce high spending, and to hit their 2% inflation goal. And what that means is, you know what, it might be harder to borrow on a line of credit or borrow money to have staff. It might result in small amount of layoffs. You know, an analysis I was listening to this morning was saying, you know what, the jobs report came back and the job growth is slowing, but that's a positive because less, it means, you know, honestly, it means like less money being spent or less money available to be spent out in the market. And so what that does is it says, hey, I got less people buying, maybe there's more supply of stuff, maybe the price on that stuff can go down. And they're talking about long-term play here, right there. And what he means by long-term play, it could be a couple years, it could be until they see inflation come to where they want to see, they may continue to raise rates. But they also announced in this announcement, and I may be getting ahead of the video, that they're going to slow the pace of increases because think about where we are now in the fours from where we were at zero.
Mm-hmm.
At zero, what tool does the Fed have to reduce or to prevent a future recession? You know, at the start of this, when the Fed started to announce they were raising interest rates, what I was saying to people is I feel like the Fed has no arrows in their quiver because we've been sitting at 0% for so long, right? And they didn't want to do what Germany did, to go negative, meaning if the bank wants to keep money at the Fed, they're charging the bank interest to keep money, to push the money out into the public, to push the money supply out to the public. But at zero, how can the Fed work to reduce recession? They can't. I mean, what else can they do?
Yeah, no room.
Other than maybe buy a bunch of stuff and put more money into the economy, which is what they did, which has kind of helped or inflamed this inflation. So, you know, and as a mortgage professional, our industry and the people that watch these markets, and so, you know, we listen to say what Fannie Mae is saying. You know why? Because Fannie Mae is the largest mortgage-backed securities producer or generator. They're the largest buyer of residential mortgages. They buy a lot of multifamily mortgages, right? They hold a lot of paper. They pay analysts to go through all the data and look at the numbers, and economists and all that to go through all the data and look through. So one of the things that Fannie Mae has said is they expect mortgage rates to drop back down significantly, to be right now, I think they're predicting somewhere in the mid fives, but based on latest notes from Mortgage Bankers Association and from Fannie Mae's, reading Fannie Mae's notes. So they still see a positive time to buy. So what does that mean, or how do I absorb that information as far as the market I'm in? And I'm in the Florida market, Central Florida market, right? Wesley Chapel, Tampa. We are a driven housing market, meaning we still have population growth and population boom. So I foresee a continued increase in the cost of real estate and a continued increase in value in real estate, whether rates are up or down from here, right? whether we hit that double-digit mark, and maybe we will, and that might reduce what people are able to buy. It might even cause prices to come down a little bit to match more closely what people's income can afford. But we have a population-driven market. And so as a real estate investor, personally, what I'm looking to do at all times is to be in the market and own real estate in the market that has a positive outlook, that has an increasing population, an increasing development near me, that which helps fuel long-term appreciation of the value of the assets I own. Okay.
So there are some you're a friend to the show, and there are some people that know you. But give a little bit about your background, that you are an investor actually in the market currently, and
I am.
what you do for a living.
Right. Well, so I am a mortgage broker for a living, but as an investor, in this investment, this is an investment platform you run, David. And as an investor, I own 20 rental doors, and actively operate 20 rental doors. I have 5 lots that I'm either building on or selling off pretty soon. So I am actively in the market, and I'm always looking for additional potentially lucrative investments. Now, I'm kind of a high ROI person. I'm always looking for maybe that sneaky deal that's not on the table everywhere to get that return. But if I were flipping homes right now, I might be looking for a little bit of a price break so that I can ensure I buy at the right price and make that profit. Because materials might be up, labor might be hard to get my project completed on time. But do I have a concern about selling my project at the end? Heck no. Just looking at the market right now, where we at, David, you probably track this more than I do as far as supply. We're still probably below a 3-month supply on the market.
We are.
And a healthy market is what, 3 to 6 months. Like, we
Balanced
don't have a
market,
healthy
3 to 6
market yet.
months.
We still kind of have a seller's preference here. It's not February or March where we were 3 weeks of supply or 2.5 weeks supply. But we are still very much in a seller's market where you can kind of set a price and expect to come very close to that on your sale. Right?
You're so right. Earlier in the year, it was a strong seller's market. You can put a house on the market and expect, cash offers over asking price, no inspection contingencies, waiving the appraisal, contingency. You can expect that. But now we're getting closer to that balanced market. As you know, Gilbert, the balanced market is 3 to 6 months of inventory, 3 to 5 months of inventory on the market. And we can, even with the interest rate changes, we can get some from a buyer standpoint, we can get some concessions. But from a seller standpoint, 100% right, you can get at asking price. And most of the time, when you're giving concessions, you're pretty much at asking price or over asking price. So from an investor, a person that is a professional renovator, you can still buy low and sell high. You can still sell at the and get most of your ROI out of that. You may have to give a little bit of a moving expense, but if you use the techniques that we cover here in the show, you can. But back to the video, I want to make sure that you mentioned on the outset that the 75 basis points was actually baked into the market already.
Yeah, I mean, like I said, Powell's announcement actually resulted in mortgage prices and mortgage rates improving very slightly, but improving, not declining, right? And that means that the analysts that had already set where they were willing to pay for what they were willing to pay for mortgage-backed securities, because the 30-year fixed-rate mortgage, the mortgage being sold as a conventional loan, a Fannie Mae, Freddie Mac, VA, FHA loan, that is, as I mentioned on the show many a times, a market-driven rate. There is a trading platform for mortgage-backed securities. Those are the things that are produced by Fannie Mae, Freddie Mac, Ginnie Mae, and sold to investors. And those investors might be pension funds. But let's look at it like this: if the general investor could get a very reasonable return buying mortgage-backed securities right now. If you are obtaining a mortgage at a 7% interest rate, there's probably 1.5% built in there to cover fees and costs and in the sale and all of that. But the end investor on that 7% rate is probably making 5%, 5.5% as a return on their investment. And so what happens is families already grouping up these, they may be grouping 100 of them or 1,000 of them, right? And saying, hey, here's a mortgage-backed security package of rates at 7%, 30-year fixed with a 720 FICO or better. Who's going to pay me what for this, right? Who wants this income over the next few years? Because really what a mortgage product is an income product. I trade an upfront dollar amount for income over 30 years. That's what you're doing. As an investor, and that's a pension fund that wants that, whether it's a state government or an IBM or some company with a pension that they got to pay out long term and they want that income. It's kind of like if you were to go out and buy an annuity yourself. You pay an upfront fee and they give you money back over time. You collect interest or return or dividends, I guess you could say, on that return over time. So already baked in, just back to your question, the mortgage, if it hadn't been baked in or it hadn't been expected, what would have happened in that bond market is rates would have jumped up.
Right. And that's what I was going to mention is that because it's like, like like stocks, when you beat expectation or meet expectation, it will actually lessen the impact. It's what the problem you have is that if you don't meet expectation, that's when everything starts getting kind of.
And we might have seen a bigger improvement had he said, okay, we're going to do a 0.5 percentage point increase instead of a 3/4. The expectation was a 3/4% from the mortgage-backed security investors, from the MBS markets. That was the expectation. Right.
Now, he mentioned a concern about their goal is to slow interest, the inflation to 2%, and how they view it as a long-term goal. Let's go back and see what else he says. Okay, you have a little bit more time. I know you have to go.
I have about 5 more minutes, Dave.
Okay, well, let's go ahead and wrap this up on your segment, and then what I'll do is I'll play the entire interview and then have some comments on that. Yeah. Now, with respect to the average person that is investing and the average person that's buying, what do you see there currently? You said that you see some improvement, but let's rub our crystal ball to the end of the year. What do you see?
Well, for the average person, so one, I still think we have a very strong buyer's market, and the reason you do is because one of the things you see around the country is increase in rent. And Dave, you said it on this show. I've said it repeatedly. I mean, this is an investor show. And so we are all very in favor of renters, right? Very much in favor of renters because they pay our mortgages. They help us build our equity. But if I am a renter, I am seeing the cost of renting increase pretty significantly. In my conversation as a mortgage broker with buyers who come in and tell me they want to wait or they're expecting to go the next year, it's one, you're going to miss out on equity. It is two, your rent's going up. And to be honest with you, your rent is going up and you get nothing for it, right? The interest rates are, let's say 7.5% or something like that right now for a good credit borrower putting 20% down, but a good credit borrower putting 3% down gets almost the same rate. That borrower gets equity out of every mortgage payment they make, right? They're paying principal down and their time in residence builds equity. And so from a borrower perspective, what am I seeing? I'm still seeing people who want to buy homes. And once you explain to them kind of and please don't take this as literal or exact, but I'll just, as an example, if I buy a house today at $100,000 and I can get into it at 3% down payment and have the bank pay 97% of it, I put $3,000 into this investment. And let's just say Tampa's market normalizes in terms of growth and we stop having this 20 to 30% year over year growth that we have. Let's say we go to 5% growth. So I put $3,000 up to buy this house as a down payment. and in 1 year I have a 5% return. My return on investment, because I only had to pay for 3% of my investment, is, and again, this is not literal, but this is illustrating kind of the benefit. My return on investment is over 100% in that first year, right? Now, if I put 10,000 or 10% down, my return on investment might only be 50% that first year. But by year 2, I'm probably at that 10% mark, and I've gotten 100% of my return back. Now, you can tell me about the stock market all day, but real estate is the most sure return on your money that you can make when it comes to low down payment. It's the only investment, in my opinion, where you can have the bank pay for, in the case of a veteran like yourself, 100% of the investment, and you get all the benefit of the returns, and for the standard first-time home buyer, 3%. Or for the real estate investor, you put up 20%, and the bank pays 80% of your investment, and you get the return from it. Come on.
And I know off screen we've talked about that new program that they have for hurricane.
Yes.
Yeah, let's talk about that real quick, because we talked about the 100% in loans. What is the 203H?
So the 203H is a HUD program that allows for anyone who is in a federal declared disaster area. And so in Florida right now, that could be, basically is Pasco County on down. They added Pasco about 2 weeks after the storm, it seems like, because of a few flood claims and all that. But a federally declared disaster area where you can document and prove that whether you were renting or owned, your home was impacted by the storm in a way that made it either uncomfortable to live in or not livable, right? So if you know a disaster victim who may not have down payment but has the income and work history to qualify for a home, this is an FHA loan, so very flexible on terms that can allow somebody to get in for 100% financing on their home. And this is not a down payment assistance program. This is just 100% financing up front. It's really good interest rates as far as compared to those down payment assistance programs. And the requirements are pretty slim. I mean, people in the disaster area who can document damage to the place they were staying in are mostly going to be able to qualify here. And that's good for a year after the declared disaster ends. So it's a great program if you know someone in South Florida who has been impacted negatively by the storm, whether they be an owner, property owner, or a renter. And one of the caveats is if they were a property owner, we can qualify them for a new home, even if the old home hasn't been paid off that was damaged, as long as we can document that they're in negotiations with their mortgage lender and the insurance company to get that prior loan paid. We can exclude that debt. All right.
What areas does it cover again?
Federally declared disaster areas. So, honestly, that's like Pasco County south.
All the way to Miami and past.
Yeah, so parts of it, yeah. So again, you had to be declared. I'm not gonna say every county was declared.
Right.
Some of those declarations come just from flood claims that happened after the fact, right? And maybe weren't even impacted by the wind, but because that storm created some flooding in places, and that's how Pasco got added. Because originally Pasco was not on a declared area.
Right.
Hillsborough was, but Pasco had some flooding cases that resulted in boom, storm damage, that claim.
100% loan, and so there's no down payment, but you have to income qualify.
You do have to qualify that to income wise, but it is 100% financing on that. And you, come up with your closing costs can be gift funds or paid for by the seller. Remember, FHA allows 100% of your closing costs to be paid by the seller, up to 6% on the price. So, you could really be in that thing for no money down, out of your pocket. So it can change lives, if people take advantage of it.
Great opportunity.
And it can be combined with a 203K loan to repair. So if you want to be back in that area, and maybe one of the conversations I'm having with my tenant down in Fort Myers where my roof was ripped off was, do you guys want to buy this place? I can do 100% financing with renovation funds to fix it. And 6 months of mortgage payments built into the loan.
Wow, that's an awesome opportunity, and so a lot of people can take advantage of that and get off of the renting and get into ownership very easily, very easily.
Absolutely. But Dave, I always appreciate being here live with you. I got to run, but you have a good evening. And again, if you have any questions, be happy to be back on at another time.
Awesome, Gilbert. Thank you again for coming on to the show. All right, so there you have it, guys. We have opportunities, and if you are in a rental situation and you want to move from rent to owning, you definitely want to take advantage of that 203H loan. All right, let's get back in and see what the Fed is saying.
I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
Over the past 6 months, we have been investigating as well as exposing the truth behind all of these food processing plants that have been catching on fire and burning to the ground. The Dutch farmers.
With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
All right, so I want to hop in here. You want to pay a particular attention about his stated goal of bringing the interest rate down to 2%. They seem to be really committed to doing that, the Fed. And so they will pull out any type of mechanism, anything in their quiver to get that done. In this brief we've been watching a few minutes here, he stated that goal at least 3 times. So guys, that is something to pay attention to. Let's continue on.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
The midterms are...
All right, so there you have it, guys. A couple things that were important. They want to reduce the interest rate to 2%. He said that they were committed to doing that. So if there's some other rate increases that they need to do, they're committed to doing it. There's not joking about that. But as Gilbert Bennett said, if they signal what the rate increase will be, and that is then baked into the market, and they meet that, it may not be a bad thing. Inflation going down is not a bad thing. So, again, you definitely want to think about where you are in the buying market, and if some of the rates that they're doing now, if there are anything that they're announcing for that you can take advantage of, any type of program that we mentioned, the 203H program, you still have opportunities from an investment standpoint. Most of us are using hard money anyway, which has a higher rate, and it won't fluctuate as much as the rate for a buyer would fluctuate. So let's go in and see what the question and answering section is, and see if there's anything that we need to consider from his answering the questions from the reporters.
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see. But I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. And I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley with New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
I would describe myself as a fighter. I'm John Morgan of Morgan & Morgan. I fight the powerful for the powerful.
We have a commercial going on now. We're going to skip past that. There was a couple of points that, again, I want to point out is that he did not think that inflation was entrenched. What that means, guys, is that while they're fighting and they have a goal of 2%, it's not entrenched, meaning that it's not going to be one of these long-term things. He thinks that, they've been 18 months that we've been in this, and we can get out of it. He don't see us getting out. It's at least the signaling he's giving us is that he do not see us getting out shortly, and he do see that there is some more room that may need to be done, some more things that may need to be done to get the inflation under control. Let's go ahead and add them back and continue on. Also, I'm doing these to make a point. Is that is you've been in school, right? And the teacher would say, "Hey, we have a test coming up," And it's really important that you know this, and or you really need to know this technique. Well, that's what we're getting from here, is that he would, the tonality, and we're committed, this is our goal, is more than just a statement. He's not just reading off of his script. They seem to be really committed to doing this. So you should take him at his word. And I'm going to do, as a way for us to kind of clue in, signaling, and try to glean a little bit of the point he's trying to make. Because sure enough, when they go back in December and take a look at this again, he's going to look at these key points that he's discussing. So let's add him back and let's continue on.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is, it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And, the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so, from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint. Remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lags. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Over the past 6 months, we have been investigating as well as
as I stated, they're not going to stop. They're not stopping. He has stated goals and uh, said directly no pause to rate hikes. So you get some of these talking heads, and they're like, "Well, the Fed should do this, and the Fed should." The guy just said, "Hey, listen, I ain't pausing." So he is not only signaling what he's going to do, he's outright telling us, "Hey, listen, we're not going to stop. We ain't stopping. We're going to get this under control. We're going to get the interest rate down to 2%, and we're going to do what we need to do from a Fed standpoint to do it." All right, let's see what else he's saying.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? So the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Right now, there's a better way to travel.
All right, so let's unpack what he just said, guys. He said, and I quote, "The housing was overheated. They are aware of the housing decline. The housing need to be balanced," and that's what we discussed in the pre-show. Is that the housing market is starting to get more toward a balanced market. And that's what the Fed that's where the Feds wanted to be. They wanted to be balanced. They don't want it to be overheated. Now, what he also said was the underpinnings of the housing market was good. It's not like back in the day where you had these fraudulent loans, these straw man loans, these you breathe on it. If you can breathe, you can get a loan. Those days, they're not seeing that from a Fed level. So they're not concerned with that. So that's great. That's great. But again, key points that he just said in that brief segment is so important. One, they are aware of the housing decline. And then he also mentioned in some areas it actually is increasing. So that's okay. But they want it to be a balanced market. And they were aware that the housing market for a brief period of time was overheated. Okay, so let's see what else you got. And that's important for us because the housing market is one of the major concerns, especially from us being an investor. What the Fed thinks about the housing market and what they're going to do, what tools they're going to do to heat it up or cool it down is important to us. That directly affects us. All right, let's continue on.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy and unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down, the compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's a picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that'll be discovered empirically.
So we just covered labor set of questionings, and I want to highlight a couple of points here while the commercial is playing. All right. So he said 50-year low still, um, historically low. He said that he did see that it was an overheated market. Um, they he didn't seem like he was overly concerned. He wants to get the labor. He wants wages to go up, but he still wants that 2% inflation. That's still their goal. So higher wages, still 2% inflation. So he was very clear about their goal with respect to labor. All right, so that's important, guys. Wages up, 2% inflation, slight overheating, but not a major concern. Let's see what else he has to say.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
No.
All right, so got some notes for you guys on this one. So they touched on the global, the globe and the international uh, global recession. And what he said was he did acknowledge that globally it was going through a difficult time. He acknowledged that the war in Ukraine is affecting a lot of things, primarily uh, food and fuel shortage. So, you know, generally on both sides of the aisle, we support um, the war, and we've been given billions of dollars and some aid. We haven't put any boots on the ground, but we've been kind of helping out. And you got to realize that it's a small world, and all these things are connected. So because we have a war in Ukraine, he stated that it is affecting the economy globally. It is affecting food shortages, and it is affecting fuel. He also stated that he see that the U.S. has a 5% ish inflation over a 12-month basis, and that the U.S. price stability is a good thing for the world. Then they moved on to specifically about food and fuel. Said they don't really have an effect on that, but they have some tools that can help the demand side, and so demand supply side. So, yeah, let's see what else we have.
Janelle Marti with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. that curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that, what's the level we need to get to rates. And, I don't know what we'll do when we get there, by the way. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
I would describe myself as a fighter. I'm John Moore.
All right, so in that segment, not that much. We have one big thing is they say they fixed it. Guys, they say they fixed it. You can't get up there and have the appearance of inside trading. There's a 45-day lag. It has to be approved, any trades that you do. So, they fixed it. They also referred the whole investigation to the Inspector General. Will somebody go down? We don't know. But from his eyes and the board's eyes, they fixed that bad boy. So good for them. Let's add him back to the stream. Let's see what we got here.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over tightening going on, or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow, it looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things. And what those things tell us is that, our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
All right, so it looked like he's circling back around to restate his commitment to getting inflation down to 2%. That's a real thing for them guys, and he seemed to be dead serious about that. He restated that it's a long term. You think it's not going to happen. It's not right around the corner. It's long term, and that the Fed they're going to raise rates again, guys. So we're getting close to the end of his interview. I'm going to give my thoughts, and then we're going to see if this is something that we can use as investors, because there's opportunity. There's opportunity in when we have growth and when we have contraction. And so it's our job to weed through these tea leaves to figure out when we should pull that trigger. So let's continue on. See what you got here.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time. And that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay, right out of the chairman's mouth. It looks like he's really concerned about this inflation, getting inflation 2%. I think the whole conversation is their focus is getting inflation to 2%. They will raise their rates. They will do whatever they need to do to get there. Now, what does that mean for us? For the small investor, for the medium-sized investor, for the larger investor, what can we glean out of this? Rates are going to go up. Rates going up. So you need to plan for that. Like Gilbert said, the market from his side, from the traditional funding side, lending side, they bake these rate hikes, these anticipated rate hikes into their metrics. And if they have baked in 75 basis points and they actually come in at 50 basis points, then the market is going to improve. So they have this kind of baked in, same scenario. If they have baked in 75 basis points and it comes in at 100, the market is going to tank. From our standpoint, if we know that the interest rates are going to go up, that's what the guy said. I don't know. I should have counted and said that how many times he said we're going to get the 2% down. We're going to do whatever, the inflation to 2%. We're going to do whatever we need to do that. I might go back through there and count that and have a little ticker up. Like, you go to a movie and you see, the kill count and, there's like a ticket off. I think that I might do that. But he said it a lot, guys. He said it a lot. So he's committed. From an investor standpoint, we need to make sure that the deals that we engage in it's not like we should take our ball and go home. We should still be out there. We should still be looking for deals. We should still be looking for that meat on the bone, the ROI on every investment. But we need to bake in to our analysis that the interest rate for our end buyer, if we are a to C type of investor, we actually build or renovate homes to a consumer and we're not wholesaling. Okay. That we need to bake that higher interest rate in and potentially maybe some tightening in. Maybe we need to have a pricing structure where we're giving incentives to our end buyer. Maybe we need to do, some other type of unique financing, pay more of closing costs, that type of thing. There's tools that we have that can help us mitigate the interest rates. If we know that something's going to happen, we need to plan for it happening.